first thing I wanted to ask is, does anybody have any success stories with the Facebook Messenger strategy? Karen, you didn't do it yet?
Not yet.
Okay.
It's on my list for this week, though.
Okay. Jim, I
Jeff,
know we talked. Yep, go ahead, Becky.
Becky Beecham, I've used it, but not with a lot of success, particularly with lower priced properties. You get a lot of messages that really aren't pertinent.
So Becky, I had this conversation with, I think, Deb, was it you? Somebody was sending the piece that we gave them, the words, to leads. What you're supposed to do is in Facebook Messenger, send it to people you know. Send it to your friends and family you know that own a home. This isn't supposed to go to strangers. This is supposed to go to people that already know who you are. Is that who you're sending it to?
Yeah, I kind of did it just to everyone, and that probably makes more sense not to do that.
Yep. So Becky, if you send it to people that you know, so say you send it to your cousin and you're like, hey, listen, I'm setting aside a couple hours this afternoon to do CMAs, which actually give you a true evaluation of what your home is worth. Because values have gone up a lot in the past couple of years. You don't even need to be selling right now. Would you like one for free? And
I think awesome.
Yeah. And then, because here's the stories we're hearing are, hey, Jeff, I had to stop because I'm too busy. Like, Jeff, I have 5 buyers and 3 listings right now. These are all in less than 2 weeks. So, and we've got probably a dozen agents that have shared those wins with that strategy. This is the best strategy we've ever seen implemented. The second best one would be the how to win for sales by owner, the withdrawals and expireds that we did in March. But this one is super simple. All you got to do is cut and paste it, put it in your Facebook Messenger, start those conversations, build those CMAs, and then have at it.
Awesome.
Cool. Becky, I'm excited to hear what happens from here.
I'll do it. Thanks. I'll let you know.
Uh-oh. Beverly Herndon just came in, so we all need to behave right now.
And bow.
The other thing was, who is everybody following us on social media? Have you seen our social media lately? Karen, you haven't?
I'm not, no.
Okay.
So it's Lagoni Mortgage Group?
Yep.
Okay.
Karen, are you on Instagram?
Oh, I am, but I don't use it much. I use Facebook much, but I'm thinking maybe I need to get on there more.
Yeah. So we put it on Facebook as well. I got pushed onto Instagram and TikTok this year by my team earlier this year. Like, I'm a Facebook guy, but there's a ton of stuff going on Instagram and YouTube. So if you haven't followed us, follow us and look at the work that Abby is doing. And Abigail Pease is on this call right now. She's going to talk at the end about how you can improve your social media as well. So she's crushing it. She's doing so good. And we're getting so much traction and we're impacting lives. And I can tell you, I've had at least 5 high school kids and 1 college kid book a time with me going, I want to buy a house. How do I do that? And I watched your TikTok, or I watched your YouTube, or I watched your Instagram reel. And then I have a few friends that are in their 30s that never dreamed of owning a home that are like, man, after watching that, I want to own a home. And the difference for that one gentleman between renting and buying over 9 years was $189,000 net worth. So if he buys the house that he's currently renting, in 9 years, he has $189,000 to his name. So I know people are starting off the conversation with me. They're like, I know it's not a good time to buy because rates are up and prices are up, but rent is going up even more. So if you get a mortgage, your payment's fixed. You start building equity because of the appreciation. You start a forced savings account because every month you're making a principal payment. And then depending on your tax situation, you get to write off the depreciation. So keep that in mind. So we're going to get started here talking about our loan program that has really moved the needle this year for a lot of homeowners. Okay, Krista, you want to start us off?
Yep. So we have a loan program right now that comes with down payment assistance, and it has been a game changer for a lot of buyers who don't have the money that they need to close. So most programs that you're familiar with that have down payment assistance available usually have low purchase price limits and low income limits. And this one is not that. It's pretty awesome. So the maximum purchase price for this program is $484,600. And then before we go to the next slide, what are people seeing for other down payment assistance programs? What are you expecting an income limit to be? So usually those are geared toward like low to moderate income. So what have you guys seen or experienced as far as the income limit with those? Any guesses? If you don't know, what would you guess?
And even if you don't want to unmute yourself, you can throw it in the chat.
About 80,000 per household.
That's pretty good. There's a lot of them that are right there around 80. Some are even less than that. But go ahead to the next slide, Renee. How about that? The maximum qualifying income for this program is $180,200 per year. Now, if you notice, we're saying maximum qualifying income. So that means that we're only looking at the income that we have to use to get the borrower to qualify. So sometimes, let's say, for example, a financial advisor, they might make a base salary of say 85,000, and then they might get 50,000 in commission each year. Well, if we're qualifying them on that base income only, we don't even have to count that commission towards the qualifying income. So someone that might have a little bit more income than this would actually qualify. And we're only looking at the borrower. So a lot of down payment assistance programs are looking at household income, and anybody that's in the household over 18, we have to look at their income, whether they are on the loan or not. So are there any questions on the difference between qualifying and household income?
So, Krista, if I hear you right, if you have a married couple, right, and say the wife makes 170,000 a year and the husband makes say 80,000 a year, structured like that, if you had them both on a loan, they wouldn't qualify.
Correct.
But you could take the husband off, and
Correct.
then she qualified by herself for this loan program.
And then, of course, with a married couple, she could automatically be on title. Any other questions on anything that we just covered? Awesome. Pretty straightforward, but pretty mind-blowing. So
yeah, because for us, it's always been about low to moderate income families to get the down payment assistant loan programs. And this one pretty much opens up to everyone we know. So it's available, and it's changing lives. And Chris is probably going to get to it here in a minute, but she had a customer where it really impacted them as well.
I had a buyer who was pre-approved through another lender with an FHA loan. And by the way, this can be for government loans like FHA, VA, and also for conventional loans. So in a lot of cases, this is eliminating your need for seller assist. And in a second, we'll get on to the details of the down payment assistance itself. I know we're just going over the qualifying aspect here, but I have a borrower who was qualified regular FHA, needed a full 6% seller assist, fell in love with the house that even the full 6% seller assist was going to still require them to have more out of pocket than they needed just to cover their down payment. So with this program, I was able to get them into the house, less out of pocket, and pay off debt that they otherwise wouldn't have been able to do because they had such a large chunk of down payment assistance. So it was amazing. It was beautiful.
So what's the only thing that's better than a down payment assistance loan? A down payment assistance loan that you don't have to pay back.
Let's go, Scooper.
Yeah. So the down payment assistance loan is 5% of the sales price. So on a $100,000 loan, that would be $5,000. A $200,000 loan, $10,000 down payment assistance. If you went up to the maximum sales price of $484,600, that would be $24,230 that they can receive as a down payment assistance loan. Okay, and that's money that's that's a loan that's forgiven in 10 years. There's no interest, there's no payment, and it's forgiven at 10% a year. So to keep the numbers nice and easy, on a $200,000 loan, that would be a $10,000 down payment assistance loan. And they would forgive $1,000 every year. So at the end of the first year, they'd forgive $1,000. At the end of the second year, another 1,000. At the end of 10 years, it would be completely forgiven. Okay. And the question I always get is, what happens if I sell the house before 10 years? Whatever the balance on that down payment assistance loan is, you would have to pay it back. So after 5 years, the balance is 5,000. Just like on the first loan, you pay off, you'd have to pay back the balance on the first loan. You would also have to pay back the balance on the second loan. But you would have still received $5,000 that was forgiven over that 5-year period.
Scott, can you use it for the down payment and the closing cost?
So it's a little bit different than seller assist. Seller assist can only go to closing costs and prepaid items. This can go towards your down payment. So, the only requirement for PHFA is that you have $1,000 of your own funds. So, how many of you have had a buyer that had good credit, good income, but didn't have any money? How many of you have a buyer that can't scrape up $1,000 by closing? Not most people can do that.
No.
So that's what's required in your own funds. So if you had someone last year, last spring, and you were trying to do an FHA with 6% seller assist, anyone tried to do that last spring when there were multiple offers?
Yeah.
Now possibly you could switch them to a conventional, 3% down with down payment assistance. If you're the listing agent, which are you going to take? The FHA with 6% seller or the conventional with no seller assist? So this opens up the doors for a lot of people that didn't have enough money and people that weren't getting their offers accepted.
That's so good. And Scott, do you have any examples where you paid off, like you had customers pay off bad debt and like improve their financial position, like after they bought, like they're buying a home with this loan program and end up having less of a monthly payout because they paid off like credit card debt or student loan debt and then got this for purchase money and was in a better situation after buying the house?
So let's just say, they qualified for a certain sales price at the beginning of the year, and now they want to buy that same house, but the interest rate's higher, and they don't qualify. One way that you can make it so that they would be able to qualify is if they had money for down payment and closing costs, well, now you're giving them a down payment assistance loan. So let's take that example, on a $400,000 sales price. They had enough money for down payment and closing costs, but that's all they had. Well, now they have an extra $20,000. So they can use that to pay off credit cards, installment loans, other items that are on their credit report, and that changes their debt to income and can get them qualified even at a higher interest rate. So it also, if you have that buyer that's just not comfortable saying, hey, I was comfortable with a $1,200 payment. I'm not comfortable with a $1,400 payment. Well, now you pay off, a couple credit cards or you pay off your car loan and you improve your cash flow by $300-$400. Well, now they're comfortable with that mortgage payment. So, a lot of things you can do with that down payment assistance money to make loans work that wouldn't work without it.
So good. So good. And we had a number of people that thought they couldn't buy. But then when we walk through with this loan program, they can buy and they're happy and they're in a better financial position after buying a house from that restructuring. Okay.
I just wanted to add one little comment about, if they were to sell their home prior to the 10-year forgiven, threshold. If they were to sell their home in, let's say, 5 years, and in Scott's example, he was talking about a $200,000 sale price when they bought the house. What are the chances that that house would have appreciated by more than the $5,000 that they have to pay back that wasn't forgiven?
Right.
Pretty strong, right? So even if they do sell the house, the chances of them ever having to take any money out of their own pocket to pay off any portion that wasn't forgiven is very slim. They should, just be able to take that from the appreciation.
Yep. And Bonnie has a question. Bonnie, there are 2 loans, right? So there's the first loan that we do, which will be either a conventional FHA, USDA, VA. And then there's this second, which is the forgivable in 10, which is 5% of the purchase price. Right. So that second will be forgiven. And in Scott's example, if they bought a $200,000 home, they would get 10 grand on that grant. And it's forgiven at 10% a year. So you divide 10,000 by 10 years, they'd be forgiven $1,000 each year that they live in the home.
What's this loan called, Jeff? What's this loan called?
So this is the K-FIT program.
K-FIT?
Yep. It's FIT stands for forgivable in 10.
I see.
The challenge with this loan program is 2 things. Number one, they're tough to process. They're not easy. We as a team have been doing these loans for 7 years. We actually got an award like year after year for being like the top producer in Pennsylvania for these loans. The other part of this, why you don't see a lot of lenders doing it, they don't pay much. They're not profitable. And so in my mind, I want everyone to win. I don't care what it costs. I don't care if I get paid or not, because sometimes these loan programs are the only programs that can get somebody into a home. And the reason they were created is for low to moderate income families. And man, that's the first step towards cracking up out of there and starting to build a net worth. So me personally, I'm never not going to do these loans. So that's why you see some lenders that just won't do them because they're not profitable enough. And for me, that doesn't matter because I just want to see families win. I want to see people get up out of there. So those are 2 things. They're tough to they're hard to process, which we have it on lockdown. Corey Beadle's our processor. Everyone on the team knows the guidelines inside and out. They're tricky. And, Corey has people calling her from really all over the country to ask her questions about how do you process these. So, any other questions as far as what Scott covered? Everybody good?
Yeah.
Okay. Tom, you want to share a story about a customer you have for this?
Yeah, just to kind of piggyback off of what Jeff said, these programs are extremely nuanced, and you guys have a really awesome resource in all of us because we went through so many of these and kind of went through all those little nuances. And between Corey processing and knowing pretty much everything there is to know, between the other 3 of us, I can promise you if I don't know something, Scott does, and Scott doesn't know something, Krista does. So we all have each other's back and know this program inside and out. I had a customer 2 years ago who was going through another lender, and when I talked to him, he gave me a cost sheet from them that was just insane. I mean, the down payment assistance portion was huge. The interest rate was insanely low, and it wasn't even in the ballpark. There was no way we were going to be able to get close to that. And he called me back a year later and he said, "Hey, Tom, I want to buy another house." And I said, I'm going to be honest, I'm surprised you're calling me back because that other lender that you talked to last year absolutely killed me. What happened there? And he's like, "Tom, I should have just went with you from the beginning. The down payment assistance was way more than it ended up being at the end. They kept changing it. The interest rate went up 3 times and they took 4 months to close the loan." So there's a lot of lenders who just don't really know how this program works. So they kind of slap it together, misquote the borrower, and then it turns into a disaster all through the process because you have issue after issue with getting it closed, all the little guideline nuances of things you need that most lenders don't know. So that's why, between me, Krista, Scott, and Corey, you're in such good shape because we have such a good handle on this program. And like Jeff said, we actually, I think we're the top lender for these type of loans a couple years in a row. So I just wanted to let you know that, just so you know, you have a really good resource in us. If you have questions, comments, concerns, any one of us can help you.
What's the timeline for closing? Is it-
Corey
We can
Beadle.
get them
No,
closed.
you better not speak for Corey Beadle. Don't do it. Don't do it.
I'll let Corey answer.
45
Yeah,
days
Corey's the
minimum.
boss here.
45?
Yes.
Okay.
Scott or Tom, you can thank me later for not getting in trouble, bro.
Yeah, you're absolutely. Thanks for jumping in. I don't want to back her up. Last thing I want to do is upset Corey.
That's right. And the one thing that Tom said, when you don't know the answer, what should you say?
I don't know.
I don't know.
Oh, I'll get
Like,
back to you.
right. I don't know, but I'll get back to you. We've had other loan officers that we're competing against say that program's garbage. I don't know why you're in it. I don't know why they're structuring you in that loan program. That's for low to moderate income families. You won't qualify, and bashing us. And then we end up closing the deal.
Mhm.
Right. And it's really good. So if somebody ever starts bashing or talking negative, ask them why. Like, just ask for the details. Say, can you look into that and tell me why you're saying what you're saying?
Yeah, we
because
have
it's-
one that's closing, to that point, Jeff. We have one that's closing next week, actually. And he talked to a couple different lenders. I gave him, the ins and outs of this program, told him that he needed 6,000 to close. Another lender had him at 19,000 to close. And when he told that other lender that he wasn't going to move forward, they said, well, what program are you getting into now? And he explained it to that other lender, and he said, well, let me tell you now, you don't qualify for that program. And now we have him approved and about ready to close. So he definitely did qualify. I just think the other lender maybe, didn't have enough experience with the program to fully understand it.
Yeah. And for years, like, I started doing this loan program, and I don't know if you guys remember Mr. Ernie, who I used to work with. He was in his 70s. I mean, they would send him out to Golden Corrals that were not profitable, and he would fix them up. He's from Texas. He moved to Pittsburgh just to be with his grandchildren. And he did loans just because he can't sit still. And he hopped into these PHFA loans, and he taught me these back in like 2007. Mr. Ernie and I were the only two people that would do these loans. No one else wanted to do them because they're tough and they don't pay. But we kept diving in, we kept doing them. And it's crazy to our team that this year, we've always done them, but this year that this would be a differentiator. Like, it would be the loan that helps people get into homes in a tough market like this. So a lot of lenders don't know this loan program, and they're not diving in to learn it because they're always told to stay away from it. So any questions about that loan program before I turn it over to our most magnificent social media person ever to walk the planet?
Nope.
I'm not even joking. I'm saying that one with a straight face, Karen. Like, she comes in here and just, you should see the video I give her, and she turns it into videos that are just incredible. Is it going anywhere soon? No, Rick, it's here. Yep. Cool. Abby, have at it.
All right, we have a couple minutes. So I'm going to give you 3 of the most important things you can do right now. 1, social media, whatever you have, use that. So whatever you're currently on, if that's Facebook, use your Facebook. If it's Instagram, use your Instagram. Do not get overwhelmed by TikTok, Twitter, WhatsApp, Snapchat. Don't worry about it. Just focus on the thing that you have right now. So if you already have a platform on Facebook, I would make one that's for your business. So if you don't have anything, create a business profile. If you already have a personal page, use a separate one for your business. When you mix them together, it can just get a little, like, Jeff has a personal Instagram and Facebook, but he has a business account for your actual business stuff, right? So 1, use what you already have, start posting on it. Don't go crazy. Don't start posting 59 times a day and start throwing up all over your platform right now. And I guess we can go so much more into this, but if you're not actively using a social media platform, not everybody is seeing your stuff. And so when you begin posting, you want to just do it once a day, but be consistent with it. So it doesn't have to be facts about real estate. It can be, right now, we're in a really great time to start because it's the holidays. And so you can actually drum up what's the word that will make sense? Like traffic on your page and letting the algorithm see your stuff by just posting things like, what's your favorite Thanksgiving side dish? And having people comment on it. Like that actually brings traffic to your page. So it's a great time to start using social media more because there's so many things outside of real estate that you can start posting about that actually brings people to your page. So use what you already have and just start posting. Also, be visible on social media in general. So what we do for Jeff's page is I'll just go and I'll just start liking other realtors, other loan officers stuff because you want people to just see your name start showing up. So if you're on Instagram, search local realtors, search local businesses that you've worked with and just start liking or commenting on their things. That starts bringing people, you start showing up on other people's feeds and the name starts becoming recognizable, if that makes sense. 2, be authentic. Do not be someone you're not. So one thing that Jeff does really well is when he's speaking, you know, it's coming from his heart because that's just who Jeff is. And so he's not trying to be some hip, trendy guy that's like throwing out some wide. Like
I'm not hip and trendy.
You are in your own Jeff way. And what we see. He's not trying to like wear a jersey and a hat backwards. Like he's just being who he is. And people know if you're being authentic or not. Like people aren't dumb. I mean, some people are dumb, but most people, especially this younger generation, they can sniff out like inauthenticity so quickly. And that's why like you don't need to be intimidated with only creating content that's super professional. You don't need a ring light. You don't need the best camera. You don't need all of this stuff. The reason why TikTok is becoming the fastest growing platform is because people are just simply like taking their phone and talking about what's going on right now. It's not polished. Like Instagram is very, you can make people think that you have a life of whatever you want it to be, but TikTok is very authentic in the moment. And so don't get like caught up with like having to have products and like ring lights and looking as it doesn't matter. Get in your car and start talking about what your experience with your clients have been, because that's being authentic.
Mm-hmm.
I talk to the team all the time. Like if there's something that's coming up that you're talking to clients about, that it's something, man, like they keep asking this question. Everybody, I wish more people knew that it wasn't this complicated. That's what you talk about because people don't want to feel stupid. And what you guys get the opportunity to do is walk people through a really like significant decision in their life that they're, believe it or not, going to remember for a long time. And so you don't want people to feel stupid, right? And so people start building trust with you when you can speak to them in a way that's like helping them, not just like speaking at them. And really quick, the last one is know your numbers. So for us, Facebook and Instagram are completely different demographics. Our Instagram, our top age demographic is 25 to 34 and then 18 to 24. So like a ton of people that we reach on Instagram is way younger. On Facebook, it's 45 to 54 and higher. Like it's completely different. So the things that I talk about or really push on Instagram or TikTok are the same content, but they're interacted with a different way. So just know who you're talking to. But Facebook is still 2.9 billion people are on Facebook.
Wow.
And for us, it's very specific on Facebook. Like our top cities on Facebook are Canonsburg, Pittsburgh, Washington, McMurray. On Instagram, it's Mumbai, New York City, Delhi. It's like, it's a completely different demographic and people. It's like Instagram has become our like, hey, this is who Lagoni Mortgage is. This is who Jeff Lagoni is. But Facebook is like, these are the people that we're interacting with every single day. And that's important to know. So know your numbers.
So
use what you already have, be authentic, and know who you're talking to.
Start with where you are with what you have, because what you have is plenty, right? Yep. Any questions about what Abby just said?
Nope.
Number one, the side dish most important for Thanksgiving is green bean casserole. There's no debating that.
There is debate, but
There's no
Has to
debate.
have the onions on the top. The canned
The
onions.
dried onions, 100%.
I'm sorry, but there is debate in that, Mr. Lagoni.
Uh-oh. Uh-oh.
There
I
is
was being on my
I
best
agree,
behavior right
I
here.
agree,
What's the
Beverly.
debate?
I like green bean casserole, and I exceptionally like the Paula Deen recipe. But I have an apple sausage
Oh,
dress stuffing
you had
that
me at sausage.
takes over my green bean casserole.
Oh,
Is it
So-
your house this year?
yes.
No, at my daughter's house.
She lives local though, right?
She does live close.
Okay. It's drivable. I'll be there. I'll be there with Tupperware.
Oh, okay.
The other thing is, so Brian Tessier, like I went to junior high and high school with him. His name was Brian Tischer back then. So when you post something on social media, is he in your comment section? Do you notice him in your
No.
comment section? Lisa, I see you shaking your head. He is on everybody's post. He was one of the first people. I remember seeing him at the Cecil Fair, the St. Patrick's Fair, like back in the late 2000s, and he went to a social media class. He was one of the first people to hop on social media and start pushing it. And he masters it. He gets after it. So watch him and try to see what he's doing. Like he'll post on, as soon as I make a comment, Abby, when she first started with us, she's like, who is this guy? And I'm like, he's going to be on every single post. And what he's doing is he's getting his name out there across all platforms, across all your people every time you make a post. Not that you need to be like that, but that's what she was talking about when she was like, hey, make sure you comment, but genuinely care. Like you're not doing it selfishly for yourself. Like you want to comment on people like you actually care about them. I don't comment on every single person's post just to put my name out there. I comment on people's stuff like, Bonnie, when you did your video, I was like, hey, Barker's Beauties, because you opened up and you're like, hey, this is what you can buy in Burgestown. And it sounded like Barker's Beauties, right? And I'm like, I thought that was awesome that you stepped out and did that. And to that point, if anybody has an open house this weekend that you would like a real shot on, Chantel, I think, is going to be going out. She went out last weekend. She'll video it and say, hey, this is Chantel from the Lagoni Mortgage Group. This is what you can buy for $350,000 in Pittsburgh. And then she'll send the video to Abby. She's going to cut it and then she'll post it out as a reel. So if that's something you'd like us to do for you this weekend, just let us know. Just send us an email, let us know. And if there's a lot of you, then I'll be taking road trips. Chantel will be taking road trips. Scooper will be taking road trips, right? We'll all come out and help you guys promote your properties. And then the other thing is, when she was talking about demographics, who knows what's the age for the number one age for first-time home buyers?
30 something.
Real close, Karen. It's 33. 33-year-olds are the most popular first-time home buyers, and there's a huge swell of 33-year-olds right now. So what you want to try to be doing is hitting that 33-year-old demographic, because those are your first-time home buyers. The other thing to think about is there is a huge transfer of wealth this year going from the boomers to like the 24 to 37-year-olds. So keep that in mind as well. They're going to have a lot of money to go buy homes. And, owning real estate is the number one way to start building wealth. Good deal. If you have any questions, shoot us an email, give us a text. We're here for you. You text that 412-253-2853 number. We always have somebody monitoring that 7 days a week. So you're going to get a response, and we're here for you.